Every investor has a dream: steady returns, no volatility, and a name they can trust. For 40 years, that name was Bernie Madoff. He wasn't just a broker, he was a titan who helped build the very infrastructure of modern trading. But behind the wood-paneled offices on the 19th floor of the Lipstick Building in Manhattan, a cancer was growing, a $65 billion hole that would eventually swallow the life savings of thousands. This is not just a story of greed, it's a story of how a trusted system failed everyone. To understand how Bernie Madoff fooled the smartest minds on Wall Street, we have to look at the split-strike conversion strategy. On paper, it was a masterpiece of financial engineering. Madoff claimed he wasn't gambling, he was mathematically guaranteeing returns. He told investors he would buy a basket of 35 to 50 blue-chip stocks in the S&P 100, companies like IBM, Coca-Cola, and Exxon. But the magic was in the hedge. He claimed to buy out-of-the-money put options to protect against a market crash, while simultaneously selling call options to generate income. In theory, this created a collar that limited both risk and reward, resulting in a smooth, upward-sloping line of profit. To an investor looking at their retirement, this was the holy grail, the upside of the stock market with none of the terrifying downside. But here is where the mechanical deception began. For this strategy to work at the scale Madoff claimed, handling tens of billions of dollars, he would have needed to trade more options than actually existed on the Chicago Board Options Exchange. It was a physical impossibility. Yet no one checked the math. Inside the Lipstick Building, the fraud was surprisingly low-tech. While the rest of Wall Street was moving to high-speed digital trading, Madoff's secretive 17th floor operation relied on an old IBM AS/400 computer. This machine was a ghost printer. It didn't connect to the markets. It was programmed to generate retroactive trade confirmations. If the market went up on Tuesday, the computer would backdate a buy order for Monday and a sell order for Wednesday. Madoff was a master of reverse engineering. He would look at the market prices at the end of the month and then instruct his staff to type up fake trades that would have made exactly the 1% profit he promised. These fake statements were then mailed to clients. To the investors, they looked like official, complex documents. In reality, they were just pieces of fiction printed in a room that smelled of old ink and desperation. Madoff even went as far as creating a fake independent auditing firm, Freeling and Horowitz, which operated out of a tiny 13 by 18-foot office. It was a one-man show disguised as a global powerhouse. For the 40-plus demographic in the US, trust is earned through community. Madoff knew this. He used affinity fraud. He targeted Jewish charities, country clubs in Palm Beach, and elite circles in the Hamptons. He made it hard to get in. If you asked too many questions, he would threaten to kick you out of the fund. This created a fear of missing out decades before the term was invented. People felt honored to give him their money. From Steven Spielberg to the local retiree who sold their family business, everyone wanted in on the Madoff secret. The most shocking part, the government was warned. For nearly a decade, a math expert named Harry Markopolos sent detailed reports to the SEC. His message was simple: the math doesn't work. Madoff is a fraud. He proved that for Madoff to be making those trades, he would have to be larger than the entire market itself. But the SEC did nothing. They were charmed by Madoff's reputation. They performed surface-level audits and closed the cases. It was a systemic failure of catastrophic proportions that allowed the bubble to grow until it was too big to save. December 2008. The global economy was melting down. Everyone needed cash. When investors tried to withdraw $7 billion, the pyramid crumbled. Madoff confessed to his sons, "It's all one big lie." The aftermath was a graveyard of dreams. Life savings, college funds, and hospital endowments gone. Madoff received 150 years, dying in prison in 2021. But for the victims, there is no true closure. The lesson for us today is clear. Transparency is not optional. If you don't understand how the money is being made, you are not an investor. You are a victim in waiting. The ghost of Bernie Madoff still haunts Wall Street today, but the most important lessons aren't found in a courtroom, they are found in your own portfolio. The first hard truth we must accept is that complexity is the refuge of the scoundrel. If a financial advisor explains a strategy that sounds like rocket science, or if they claim to have a secret sauce that works in every market condition, walk away. In the world of finance, if you can't explain it to a 12-year-old, you shouldn't be putting your life savings into it. Secondly, we must beware of affinity fraud 2.0. Madoff used country clubs and religious circles. Today's scammers use social media, AI-generated deepfakes, and exclusive private WhatsApp groups. They prey on the same human emotion, the desire to be part of something elite. For those of us building a legacy for our children, remember that the best investment strategy is often the most boring one. Real wealth is built through transparency, diversification, and time, not through black box algorithms that never show a losing month. Bernie Madoff's greatest crime wasn't just stealing $65 billion, it was stealing the peace of mind of an entire generation. Don't let your hard-earned American dream be the next casualty. Verify the auditors, check the third-party custodians, and never forget. If it looks too good to be true, it's because it is. Your vigilance is the only true insurance policy you have.